Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Scott Bauer. Hey there, Scott.
Jeff, how are you?
I'm doing great. Interesting to see we're halfway through earnings season. The markets like what they hear. We have a lot to digest this week. State of the Union from President Trump. What's your focus this week?
Focus is really still continuing on these earnings. What's the top and bottom line here? And let's see if we get any sort of rhetoric, any more news coming out of the U.S. and China tariff talks.
No, I think it's really interesting to see if that Chinese tariff conversation gets any type of resolution here in the month of February. Let's get into this first lightning round. Are you ready?
Absolutely.
Data. Well, we certainly saw some great data last week, Scott, of big jobs numbers. Certainly a slight revision to the month before, but at the end of the day, net, we're seeing some jobs being created.
No doubt about it. And, we've had this run up in the market. And really based on that, Jeff, I'm really looking at protecting this run up and maybe actually buying a little bit of a downside here.
No, that makes a lot of sense, and certainly you're seeing volatility come down, maybe a little complacency come in ever since the Fed has tilted more dovish. So what type of trade example would you utilize to mitigate risk in a portfolio?
Yeah, absolutely. As an example, I'm looking at the E-mini S&P 500 and buying the Friday week 3, so the February 15th 2650 put, selling the week 3 2600 put. So this spread will cost an investor about 5 ticks or $250.
No, that makes a lot of sense, and you see the cost of that put spread come down dramatically since volatility has been reined in. Remember, folks, the March underlying in the E-mini S&P 500 was trading at 2704.5, and the at-the-money volatility on this trade example is 12.98.
Exactly, and you just hit the nail on the head, Jeff. Volatility coming down makes this spread a little bit cheaper.
Fantastic, Scott. And please remember, these are trade examples, not trader recommendations. Are you ready for the second lightning round, Scott?
Yes, let's do it.
Crude oil climbs. Well, we have seen sensational volatility in the crude oil patch. What are your thoughts? It seems like there's some resistance at this $56 level.
There is, and with volatility still up here, Jeff, there could be some real nice premiums out there.
Well, you hit the nail on the head. And since that elevation in volatility remains in the marketplace in crude oil, I want to sell a trade example here is I want to be selling the call spread, the 56.59 call spread that allows a potential investor to collect $430. Therefore, next Friday, February 15th, if it expires under $56, you collect that whole premium, but $56.43 is the futures price where this trade example breaks even.
Right, and in this example here, like you said, it expires on Friday the 15th, and it's tied to the March underlying at $53.95 with at-the-money volatility, Jeff, at 36.5.
And I think just to reinforce the fact that we're going to see continued chop volatility is due to the fact we're seeing Venezuela front and center. We're seeing a lot of different geopolitical tensions certainly mount, but at the end of the day, the supply conversation, domestically, we continue to see supply grow. Therefore, I think that $56 level remains a nice ceiling in crude oil.
And again, this trade example here is completely risk defined.
Yeah, great stuff. Well, thanks for joining us today, Scott. We also want to thank you for tuning in to Striking Options. Please tune in every week as we will continue to strike options.